Here is Mike, who's in Sarnia, Ontario. Hi, Mike.
Hi, Mark. Hi, David. So last Thursday, I shorted Amazon, and it's really based on a sort of a macro view and candlesticks as opposed to point and figure. So, David, there was something that came out this morning. I was at work, drove the stock up to around 277. I just wondered what your thoughts are, generally speaking, regarding Amazon and the market as a whole. Thank you.
Okay. So, Mike, in the way that I look at the world, we always look for the leaders or the strongest ones in the group. And I will say that in general, retail has been underperforming in many ways. A lot of the consumer-related companies are a little bit out of favor market-wise just because there's concerns about the increased tax bill coming in the U.S. But within the retailing group, you know, the internet retailers are doing particularly well. And I would have to argue that Amazon is one of the strongest stocks in the group. The relative strength is stronger than 86% of stocks in the market currently, you know, the revenue growth has been very strong. They've got two big step function increases in earnings coming over the next 2 years. So I think in a way you're taking on, you know, the 100-pound gorilla or the 1,000-pound gorilla, and that's not the way that I would go. Now, you know, if you're looking for something that's underperforming, I would say like men's retailers like Joseph Banks or Men's Warehouse are performing poorly. And I think those would be the most likely to get hurt. Market will pick on the weakest ones first. So I think you're going after one of the leaders, and the problem is when they bounce, as you saw today, they can bounce hard and they can really hurt you in a short squeeze. So I think in general, market-wise, I think that there's so much liquidity right now out there that it's very difficult to buy things or sell things based on valuation. The Fed is forcing money out the risk curve, and people are putting money to work. And at this point, I'm not seeing any real evidence of a major problem. Certainly, it's not cheap, but money continues to flow into equities. So I think you're fighting the trend at the market level, at the company level here.
Right. In a very polite way, you're basically suggesting it might not be the best idea.
Well, I watched people lose a lot of money in Yahoo in the late 90s, you know, trying to short an expensive stock. And as they say, the market can stay irrational longer than you can stay solvent.
Right. Okay, thanks for that, Mike. Let's talk to Jeff now. He's in Toronto. Good evening.
Hi, how are you?
Very well. How are you?
Good. I've been a long-term shareholder of Brookfield Asset Management, and over the years I've been very, very satisfied with it. But it looks to me like it's topping out a bit now, and I'm just want to get your opinion. Do you think it's fully topped out, or do you think there's much room left behind it? Thank you. I'll hang up and listen.
So, Jeff, I think that Brookfield Asset Management falls solidly into one of the core leadership camps, which is companies with very strong, sustainable, predictable cash flows. The market, I believe, right now is prepared to pay a premium for predictability and durability. And I think that Brookfield is in that camp. Now, as you get stronger economic data, there is going to be some portion of investors who say, well, I'm going to make a bigger bet on more cyclical companies. And you are seeing a little bit of rotation in that area. The only thing that I can say is that in the last 3 years, every one of the rallies in cyclical stocks has sort of ended in tears, and all of those pullbacks in the more predictable stocks have gone on to make new highs. So I'm not prepared to say that I think that this rally's over for Brookfield Asset Management. I think in the very short run, there is a piece of research that's going around that calls into question some of the financial, not so much accounting, but the way things are presented. I think it's been written by some folks that are supporting short sellers. But I think that it is floating around in the market, impacting the market in the short run. But I like the markets that they're in. They're in long life assets with predictable cash flows. We own the stock, and I think it's behaving okay.
And a couple of aggressive drops the last couple of sessions. You're not concerned about that too much?
As I say, you are seeing a little bit of money rotate. I think it's more short-term in nature. And I think that there are buyers under the surface who are happy to buy the stock on a little pullback.
Okay, it's sitting right at its 50-day moving average so far. Here's Ray, who's in Burlington, Ontario. Hi, Ray.
Hi. David, this question is about pipelines. On Enbridge, is this company still a good buy at today's closing price, or would Kinder Morgan be a better alternative, do you think? Thank you.
So, Ray, I like both Enbridge and Kinder Morgan. We own Enbridge. We don't currently own Kinder Morgan, although we've certainly owned it along the way. We have quite a large basket of energy infrastructure companies in our portfolios. Look, For a stock to go from 50 go from 50 to 100, it's got to go through 51, 52, 53, and so on, and all of those are new highs. The move in the energy infrastructure stocks has been extremely durable. It's been going on for a while, and I think it can go on a lot longer. You have a long-term secular increase in volumes coming at the market, and those companies that provide infrastructure are going to be a beneficiary of that. You're going to see above average cash flow growth for the next 5 years. So could it have short-term pullbacks? Absolutely. Could the group have short-term pullbacks? I think ultimately you're going to see this theme continue, and I think that if you look at the risk-reward, there's a lot of bidders underneath the surface on every pullback. So you would start to see it get a lot more choppy before I think you saw the stock top out. So I like the stock and I'd buy it here.
Okay, 25 times earnings, you're fine with that because of the growth potential?
I think that people are underestimating the cash flow growth that's coming at these companies.
You mentioned being out west and talking to various people. What about your clients? Are you getting more phone calls now? Geez, David, I'd like to be a little more aggressive, that kind of thing, or not really?
Well, you know, we take it on ourselves in our portfolio to manage the tactical mix of assets. So, for instance, in the income fund that we run, we can go from one end of the spectrum, government debt, down through corporate bonds, preferred shares, real estate investment trusts, and dividend-paying common shares. And depending on the environment, we're going to skew it one way or the other. I will say that as it stands today, we're almost all in dividend-paying equities. We have almost no fixed income, and we kind of keep clients appraised of that. But certainly there is some more appetite for risk, but I would say it's less than people think. I would say in general, you aren't having people phoning saying, I want to be a lot more aggressive. I think the last few years has ingrained in them that we're in sort of a spotty environment. We're not exactly seeing growth run away. Yes, there's a lot of monetary stimulus impacting the market, but I don't see investor appetite shifting significantly, maybe a little bit.
All right, David, a short pause here. We'll come back and have a look at your past picks. Stay tuned.